Welcome back to the Deep Dive. Our mission today, well, it's pretty clear. We're diving into this huge AI boom and trying to help you cut through the noise. Because you see these valuations, right? Especially for the application layer, those glossy apps using large language models. They're just astronomical. We're calling that bubble A. Big enthusiasm, sky-high multiples. But the real question, the one we're digging into, is where is the actual durable value going to end up? We've looked at a bunch of sources today, and honestly, they suggest the smart money might be looking somewhere else entirely, thinking less about a market dip and more about a collision, hype meeting physics.
That collision is exactly it. Let's just put the thesis out there right away, this AI wave. It's absolutely the real deal. It's foundational. But the real wealth, the lasting wealth, is going to gather around the bottlenecks, the things everyone else needs but takes for granted. We think the first big AI crash won't even start on a stock chart. It'll start quietly, maybe at a local power substation, when the economics just don't work anymore. So if you want to build something lasting in this new era, what we're calling Bubble B, you need to focus on owning those constraints. We see three big ones emerging: data, power, and trust. Chasing the newest model or the slickest interface, that's mostly a distraction. The winning play, we think, is securing the physical inputs and the legal rights. That's the inner empire.
Okay, let's unpack that because, look at the money pouring in right now. It almost defies gravity. You've got hyperscalers planning hundreds of billions in CapEx through next year, right? Del Oro's numbers are staggering. And GPU makers, triple-digit growth. So why should we be worried about the apps bubble A when the engine underneath seems so incredibly powerful?
Well, that scale actually proves the constraint point, doesn't it? It shows AI is industrial, it's real. But it doesn't mean every app built on top is going to print money. We need to look back a bit. People love the dot-com comparison, but they often draw the wrong lesson.
How so?
The dot-com bust didn't kill the internet.
Yeah.
Not at all. It killed bad business models, Companies burning cash with no path to profit, over-leveraged balance sheets. But the internet itself, the fiber, the servers, the core infrastructure, that was real. The demand was real. It survived and thrived. And we're seeing something similar now. The crunch point for these bubbly apps is the tension around a simple, inescapable fact. The marginal cost of cognition is not zero.
Okay. So unlike traditional software, where making one more copy costs basically nothing.
Exactly. With AI, every time a user asks a question, runs a feature, it costs compute. It costs power. It's a variable cost, maybe pennies, maybe even dollars for a complex query.
Right. And that creates this fundamental problem. You've got a high variable cost industrial process, the AI inference, but you're trying to sell it with a low or zero marginal cost software expectation.
Precisely. Customers expect software costs to go down over time, or at least be predictable, like a flat sauce fee. But if using your AI app more drives your costs up linearly, well, the math breaks down pretty fast.
The unit economics just don't support those bubble A valuations if KGS scales directly with usage.
Especially when your customers want that fixed price per seat. It's a tough spot.
But hang on, what about the productivity gains? We hear these amazing numbers. AI makes coders, support agents, whoever, 30%, 40% faster. Surely that offsets the cost.
The gains are definitely real. We're not denying that. You look at studies like Brynjolfsson's work on customer support agents, and you see big double-digit improvements. Often the biggest jumps are for the less experienced workers, which is interesting.
Okay, so that sounds promising.
It is, but there's a huge but. The gains don't just happen when you plug the tool in. Brynjolfsson and others pointed this out years ago, too. You need complementary changes, things like rethinking your whole workflow, retraining staff, changing processes. That takes time, it takes investment. It's not plug-and-play prosperity.
If you just buy the fancy AI tool but don't change how you work?
You just end up with a very expensive line item on your cloud bill, probably underutilized. And the productivity gains might not show up for ages, if ever.
Okay, that makes a lot of sense. So the app layer, bubble A, is wrestling with these tricky economics. Let's move to the actual physics you mentioned. Power the first constraint. Why is this a physics problem, not just a Silicon Valley coding problem?
Because AI at scale is fundamentally industrial. It eats land for data centers, it needs massive amounts of water for cooling, and crucially, it consumes enormous amounts of electricity. The IEA, for instance, put out a projection earlier this year. They think data center power demand globally could nearly double by 2026. And the main driver, AI workloads. That's a huge shift for entire grids.
Doubling by 2026. That's incredibly fast.
It is, and the real bottleneck isn't even the GPUs anymore. Manufacturing is scaling up surprisingly well there. The real scarcity, the thing you can't just order more of quickly, is the last mile of electrons. getting power to the data center. In hot markets, building a new data center isn't limited by cash, it's limited by how long it takes to get connected to the grid. We're talking interconnection queues, waiting for transformers.
Transformers, like the big metal boxes on poles.
Exactly, but much bigger ones for substations. And the lead times for those can be years. Research from places like LBNL backs this up. It's a time-to-power problem. You can get chips tomorrow, maybe. You can't get a new substation built in a quarter.
So that delay, that physical reality, creates the moat. How does that become play one, first strategy?
Play one is what we're calling power adjacency. The durable advantage isn't finding the cheapest cloud instance. It's owning or controlling the source of power. Its price, its reliability, its location. The really smart capital. They're not just negotiating cloud contracts. They're quietly buying or optioning land right next to existing substations that have spare capacity. Or they're looking at old industrial sites, brownfield sites that already have heavy-duty grid connections.
Moving from being a price taker to
being someone who can potentially dictate terms or at least secure reliable power at a stable cost. It's about managing that physical input. Not glamorous, maybe, but incredibly valuable long-term.
Okay, power adjacency, that connects directly to the next constraint, right?
Yeah.
Data. You don't want to waste expensive electrons training on bad data.
Precisely. You can't afford garbage when the processing cost is so high. Which brings us to the data bottleneck.
This one feels a bit weird, though. The internet seems infinite. How can we possibly be running out of high-quality text to train these things on?
The internet is vast, yes, but the pool of high-quality human-generated text stuff that's diverse, reliable, and, importantly, has clear usage rights, that pool is finite. There are analyses out there, like work by Villalobos and others, suggesting that at the rate these models are scaling, we could actually hit a ceiling on the really good language data within, say, the next 5 to 10 years, maybe sooner.
Hit a ceiling. What happens then?
Well, that creates huge pressure. Labs might be tempted or even forced to start training models on the output of other models, synthetic data. And that's risky. There's research, like from Shumailov's team, warning about model collapse.
Model collapse. What does that look like? Does the AI just start talking nonsense?
It's maybe more insidious than that. It's not like it suddenly breaks. It's more like a slow degradation. The model starts losing touch with the diversity and weirdness of real human language and data. It starts reinforcing its own biases, its own errors.
Like an echo chamber.
Exactly. It forgets the edge cases, the nuance. And if you're relying on this for critical business tasks, it's a massive liability.
And this scarcity of good data, plus the risk of collapse, that must be driving up the value or the cost of the good stuff, especially with the legal angle. This feels a bit like the music industry and Napster, then Spotify, right? The fight over who owns the content.
That's a fantastic parallel. The old assumption that training data was just, out there like a free commons for anyone to scrape, that's dissolving fast. You've got major lawsuits, the New York Times suing Microsoft and OpenAI, Getty Images suing Stability AI. They're fighting over copyright, over fair use.
So the cost curve for data is shifting.
Dramatically. If the legal precedents swing toward the content owners, then training data goes from being almost free at the margins to being a significant, potentially recurring cost.
Yeah.
Like paying royalties. Content owners are waking up to the value they hold.
Which leads to play two.
Play two. Become a data landlord. The value isn't just in having any data. It's in having deep, niche, high-quality data sets with clean provenance and clear rights. Think about things like specialized medical records, properly anonymized and consented, of course, or detailed industrial equipment logs, or maybe longitudinal financial data, stuff that's hard to get, hard to replicate.
So you either buy those rights, partner strategically, or maybe even build structures like data trusts or co-ops where creators get a cut.
Exactly. You become the gatekeeper for that essential, non-commoditized input.
Okay, so let's say a company nails this. They've got power adjacency, giving them cheap electrons, and they're a data landlord with unique, clean data. They seem set to dominate Bubble A, right? What stops them? Why is trust, the third constraint, such a durable moat? Isn't compliance something that just gets standardized eventually?
Eventually, maybe. But eventually can be a long time, and the liability risks are now. That's why trust is play 3. Enterprises, especially the big ones in regulated fields like finance or healthcare, they don't just need a clever tool, they need proof. Audit trails, provable security, demonstrable controls against bias, the compliance department, the legal team they need to be able to show regulators and customers exactly how this thing works and why it's safe.
And the regulators are moving on this already.
Absolutely. Look at the EU AI Act. It's taking a risk-based approach, The higher the potential risk of the AI application, the stricter the rules. And the penalties for getting it wrong are significant. In finance, in medicine, in critical infrastructure, managing model risk isn't just a good idea, it's a fundamental part of managing liability exposure. It goes right up to the C-suite.
So the durable asset isn't the model itself, but the ability to prove it's trustworthy.
Precisely. It's the assurance layer. The really valuable skill becomes bridging the gap between cutting-edge machine learning and the nitty-gritty world of compliance and risk management. Selling model evaluation as a service, for example, providing rigorous, domain-specific testing, red teaming exercises, building data pipelines you can actually trace and audit. If you're the one who can confidently sign off on compliance,
You're indispensable.
you are, and you can charge accordingly.
Okay, so pulling this all together, power, data, trust. The center of gravity is shifting upstream, away from the flashy app, towards these fundamental constraints. What does this mean for someone trying to operate or invest smartly in this space?
It means a really crucial mindset shift. You have to stop thinking of AI as just like this magical software thing, and start treating it like a complex industrial stack, one with interconnected physical limits, the grid and legal or social limits, data rights, trust requirements. The winners, especially in the application space long term, won't just have the best UI or the cleverest prompts. They'll be the ones who master their unit economics.
Which comes back to that cost per query.
Right. It boils down to improving the ratio of useful, trusted output per kilowatt hour. How much value can you generate for the energy you consume and the data you use while staying compliant? And that's where play 4 comes in inference arbitrage.
Inference arbitrage. Okay, for listeners maybe not deep in MLOps, what does that involve? You mentioned things like quantization, distillation.
Yeah, it's basically the relentless hunt for efficiency at the point that AI actually runs the inference stage. How do you get the same or good enough answer using less compute, less power, less time? Quantization, for instance, means using numbers with less precision inside the model. Think using 8-bit numbers instead of 16-bit or 32-bit. It drastically cuts memory use and power draw, often with minimal impact on quality for many tasks.
Okay, makes sense. Smaller numbers, less energy.
Right, and distillation is really clever. You might train a huge, powerful, expensive teacher model first. Then you use that teacher model to train a much smaller, faster, cheaper student model to mimic its outputs on specific tasks.
So the student learns from the master.
Kind of, yeah. And that student model might achieve, say, 90% of the capability, but run at maybe 10% of the inference cost. These aren't just neat tricks anymore. They are fundamental levers for managing your gross margin. They separate the survivors from the eventual bubble A casualties.
So we really have two bubbles interacting here. Bubble A, maybe the froth, the hype, lots of similar apps built on expensive generic models. That bubble pops when the CFOs look at the cloud bills and the unit economics don't pencil out.
Exactly. The CFO reckoning is coming for bubble A.
And then bubble B, the underlying infrastructure, the constraints, power access, unique data, trust frameworks. The price for those doesn't crash. It probably hardens because they are based on real-world scarcity and liability.
That's the core idea. You want your value anchored to that durable floor, bubble B. So for individuals navigating this space, what's the practical advice? Develop what you might call power law skills. These are the rare, highly leveraged abilities that sit at the intersection of the tech and these constraints.
Like what?
Like being a technologist who actually understands energy markets and grid infrastructure, or a lawyer who deeply understands data rights and AI compliance, call it rights engineering, or someone who can do that deep cost engineering for AI inference, really mastering that inference arbitrage, skills that connect the code to the concrete.
Fascinating. So this deep dive has really reframed the market. We've looked beyond the app layer hype to these three core constraints: power, data, and trust. And we've seen why the durable value seems to be consolidating upstream.
Yeah, I think the simplest rule to navigate this AI gold rush is this. Everyone's rushing to sell shovels. The basic tools, the generic models, that's going to be a low-margin, high-competition game eventually.
So don't just sell shovels.
Right. If you want durable wealth, figure out how to own the water rights. That's where the value sticks. That's how you thrive when the initial frenzy fades. Something for you to think about.